Hey traders, welcome to the ultimate deep dive into order blocks, one of the most powerful yet misunderstood tools in smart money trading. If you've ever had a trade that looked perfect, the setup was clean, the order block was marked, price tapped your zone, and then boom, it gets stopped out without warning. You're not alone. Most traders struggle here, and it's usually because they haven't learned how to identify high probability order blocks the right way. In this video, we're going to fix that. We've backtested over 100 order blocks in various market conditions to uncover what really works. Only specific patterns and conditions make an order block consistently reliable. So here's what we're covering in this full guide. A clear breakdown of what an order block really is and what it isn't. How to recognize valid order blocks using 3 key filters I use in my personal trading. The 4 crucial steps to identify high-quality zones: market bias, order block context, relativity, and retracement opportunities. And finally, the tested rules and setups that actually increase your win rate based on data, not guesswork. If you're tired of getting stopped out and want to learn how to spot the best order blocks like a pro, just keep watching until the end. And hit that subscribe button so you never miss the smart money moves the pros don't talk about. I will see you right after the intro.
Welcome back, traders. We're kicking off this course with the very first step to identifying high-quality order blocks, which is market bias. Bias refers to the market's directional context. Essentially, it's where price is likely being drawn toward, also known as the liquidity target or draw on liquidity. So, which price delivery PD array are we targeting? Let's take a look at the GBP/USD pair on the weekly time frame. You'll notice that price is revisiting a weekly order block, which I'll explain shortly in detail. From this point, there's potential for price to reach the previous weekly low, sitting in a discount zone. Also, notice how the market has been moving downward, consistently reacting to bearish fair value gaps. That gives us a clue. The market might want to continue lower. To get more clarity, let's zoom into the daily time frame. On the daily chart, price is tapping into a fair value gap. At the same time, we're likely sweeping a recent high. How can we tell? Well, although price breaks above a prior swing high, it fails to form a new daily structure and instead leaves a wick. Based on candlestick behavior, wicks often suggest fair value gaps on a lower time frame. So what might be happening here? That wick could represent a lower time frame pattern, price reaching up to fill a fair value gap before dropping into another one, a sign of manipulation. This suggests price may soon drop, targeting the previous weekly low. Why does this matter? Because this creates what we call a contextual zone, a high probability area where lower time frame setups are more likely to work. One of the most common mistakes traders make is diving into low time frames, picking out random order blocks without understanding the bigger picture. Without a proper framework from the higher time frames, those setups usually fail. But when you align your entries with where higher time frames are likely to move next, the chances that those lower time frame order blocks will hold increase dramatically until we reach the draw on liquidity. This line right here, that's our draw on liquidity. Now, let's move on to the 4-hour chart. But before we do that, we need to break down exactly what an order block is. Order blocks are strategic zones of supply and demand in the market. They are created when central banks or large financial institutions place massive orders, accumulating significant amounts of an asset. This leads to a sharp price movement, causing an imbalance between buyers and sellers. Why are order blocks important? Because when the price returns to these zones, it often reacts strongly, making them valuable for identifying potential trade opportunities. Order blocks aren't just any random bullish or bearish candles. Not every green or red candle qualifies. There are specific conditions that make an order block valid and reliable. A key requirement is that the order block forms around a previously significant level, such as past support or resistance. In smart money terms, this usually means the block should originate from a prior price delivery array, PD array. Many times, valid order blocks are found stacked on older fair value gaps or even previous order blocks, and that's exactly what we want to see. For example, let's say price is trending downward and prints a fair value gap. As it retraces back into that gap in a premium level area, we see a bullish candle or a series of bullish candles form. This retracement into the gap sets up the ideal environment. We've tapped into a premium area and formed a temporary upward move, only to continue dropping afterward. Now, as price continues lower and creates a new fair value gap within the same downward impulse, or leg, we officially have the ingredients for an order block. Let's define what we mean by a leg. In a bearish context, a leg simply refers to price movement from a swing high to a lower point. Whether or not the swing low is clearly visible doesn't matter. What matters is the presence of the swing high that starts the move. The same logic applies to bullish legs. As long as you have a clear swing low, even without the next high, it counts. So, summarizing the bearish scenario, price is in a downward leg. A bullish candle retraces into a prior bearish fair value gap. Price then drops again, leaving a new fair value gap in the same leg. This setup creates a valid order block. Once you've identified such an order block, you need to mark it correctly. Here's how.
So, how do we spot a reliable order block? Start by identifying where there was a notable surge in volume or momentum. This typically shows up as a strong, impulsive candle in one direction. For example, when spotting a bullish order block, you'll notice a sharp upward candle. What you want to do is go back to the last bearish candle just before that surge upward. This is often referred to as the sell to buy candle, and it marks the origin of the move. This candle is your potential order block. Now, a crucial confirmation is the presence of a fair value gap, a section of price imbalance created during the impulsive move. You can spot it by examining 3 candles. The first bearish candle, followed by a strong bullish candle, and then a third candle. If the high of the first candle and the low of the third candle don't overlap, it forms a gap. This is your fair value gap. When you notice this type of gap, there's a strong chance that an order block is nearby. To confirm, simply mark the last bearish candle before the move up. That's your bullish order block. Now, if you're trying to spot a bearish order block, the process is just the opposite. What you want to look for is the final bullish candle that appears right before a strong bearish move. However, just like with bullish setups, there's one key condition. The wicks of the first and third candles in the sequence must not overlap. Take this example. You'll notice that the wicks of the first and third candles actually connect. That means no fair value gap is present, which disqualifies it from being a valid bearish order block.
When marking any PD array, whether it's an order block, mitigation block, or breaker block, the fair value gap alignment is important. If a fair value gap overlaps the wick, low for bullish candles or high for bearish ones, mark the wick. But if no overlap exists at the wick, then you mark the body of the candle instead. For example, take a look at this order block. If there's no fair value gap overlapping the wick, but one aligns with the candle body, then you should mark the body. The wick is only relevant if it directly interacts with the fair value gap. Let's see another example. Notice how the fair value gap aligns directly with the top of the candle wick. Because the fair value gap overlaps the wick, that wick becomes the most sensitive area of interest. So instead of marking the candle body, we highlight the wick when identifying and drawing this order block. So why does this trick matter? It's because when price moves quickly and the wick lines up exactly with a fair value gap, that wick becomes the most sensitive part of the order block. However, if there's no such alignment, it means the wick has already been revisited by price, as seen in the previous example, and there's no longer a strong reaction expected there. In this case, the sensitive area of the order block shifts to the body of the candle. At this point, we've covered bias and how to correctly define and mark order blocks. So now let's move into step 3, which is the relativity concept. This concept is all about context, particularly how price behaves across different time frames. Market structure and order blocks look different depending on whether you're on a 1-minute chart or a weekly chart. But one rule always holds. Higher time frames dominate. Their signals carry more weight and should guide your lower time frame decisions. Imagine that you've got multiple charts open: monthly, weekly, daily, 4-hour, 1-hour, 15-minute, 5-minute, and 1-minute. If you're identifying order blocks on the 15-minute chart, don't blindly assume they're strong zones unless they line up with key levels on higher time frames like the 1-hour, 4-hour, daily, or even weekly charts. In our case study, we began by analyzing the weekly chart, which showed a clear bearish context. From there, we zoomed into the daily and 4-hour charts to refine our view. But what we didn't do is immediately trust a 15-minute order block that happens to show up below the 4-hour one. Why? because without that higher time frame confirmation, a 15-minute order block is weak and unreliable. There's actually a 4-hour order block directly above it, which carries more influence over price. So if price pulls back, it's more likely to retrace into the 4-hour block rather than the smaller 15-minute one. And especially after a fair value gap forms, the retracement will often aim for that stronger, higher time frame zone. Recognizing this helps you avoid chasing weak signals on the lower charts. Just like we've done so far, always begin your analysis from the higher timeframes and work your way down gradually. If you already identify a valid 4-hour order block, there's no need to go hunting on the 1-hour or lower, unless price actually taps into that 4-hour level. Only then should you drop down to a smaller time frame to confirm what's happening inside that zone. Now, the first 3 steps, bias, identifying order blocks, and understanding context, are things many traders are familiar with. But the 4th step, and one that often gets overlooked, is the concept of retracement. So let's break it down. Look at this bearish order block. Now compare it to another one nearby. What do they have in common? Focus not just on where they're formed, but how price retraces back into them. This particular order block was created based on a previous one. Yet notice something. The bullish order block fails, but the bearish one holds and drives price straight into the draw on liquidity. Why does that happen? Of course, it's partially due to the broader context, the directional bias, and the liquidity target. But there's another major factor, how price retraces. That's what separates the strong setups from the weak ones. Let's take another example. Here, we see an order block built off an earlier one and a previous fair value gap. The way price pulls back into this zone matches the behavior we saw in the earlier successful setup. That's the pattern we're after.
Now let's talk about my 3 key rules for identifying high probability order blocks. Rule number 1, trade with the trend. This is arguably the most important rule. So many traders make the mistake of hunting for bearish setups in an obviously bullish market. You always want to make sure you're aligned with the broader market structure. For example, if price is creating a higher low followed by a higher high, that's a bullish structure. It means buyers are in control. Once you've spotted a bullish breakout, it's highly likely that price will return to a previous structure zone, and that zone almost always holds a valid bullish order block. That's where you'll see clean reactions. Rule number 2. Look for a liquidity grab before the order block forms. After you've confirmed the market is trending, the next thing you want to see is a liquidity run that occurs just before the order block is created. Here's what that might look like. Price is moving in a bullish direction, but then begins to pull back. During that pullback, it creates a series of internal lows. Eventually, price sweeps below those lows to grab liquidity before launching higher. That final downward move, just before the rally, is the sell to buy move you're looking for. This indicates that liquidity was taken out before the bullish momentum kicked in, a critical clue that institutions may be involved. And don't forget that your order block still needs to show a fair value gap between the first and third candles in the sequence. That gap is what strengthens the order block's validity. Rule number 3. Look for a break of structure. This is my golden rule. The order block must be part of a price move that leads to a break in structure. Now, the order block itself doesn't have to be the exact candle that breaks structure, but it must be within the same leg of price that causes the break. Let's look at an example. Imagine you've got a bullish structure with a clear swing low and a swing high. As long as your order block is within the same movement that led to that swing high, you're good. You'll now want to shift your attention to the most recent sell to buy zone that occurred within this new leg, the one that caused the latest break of structure. So always make sure the order block you're focused on is connected to a break structure that confirms its relevance. To sum it all up, you're aligned with the trend. You've got a clean liquidity sweep before the move. The order block helped create a break of structure. When all 3 conditions are met and price returns to that zone, you're looking at a high probability area where the market is likely to react, possibly forming a new higher high from there. And that's the exact type of setup I personally use to enter precise, high-quality trades.
If you want more trading lessons, market insights, and live analysis, feel free to join my Telegram channel. It's completely free, and I'll leave the link in the description below.
Now, I will share with you some of my best strategies that make me consistent profits.
We put this trading strategy to the test by backtesting it 100 times on the Euro-USD pair, using the 1-hour time frame. For the test settings, we started with an account balance of $10,000, risking 2% per trade, and targeting a 4 per profit, giving us a simple 1-to-2 risk to reward ratio. Now, let's take a look at what the results showed. These are the 100 order blocks we identified during the test. Green blocks represent trades that successfully hit the 2-hour profit target. Red blocks are the losing trades where price hit the stop loss. Gray blocks are setups where price never triggered the entry, so we simply skipped or canceled them. Here's how it all added up. 28 trades didn't activate. 41 trades resulted in a loss. 31 trades were winners. That gave us a 43% win rate, with a maximum drawdown of 10%. Despite the win rate being under 50%, the strategy still managed to grow the account by 47%, which is impressive. When specific conditions align with order blocks, the chances of success rise significantly. We also began to see recurring patterns on the charts that helped improve overall performance in a big way. So, let's go over the key conditions that help us identify high-quality order blocks. But before we jump in, if you're enjoying the video so far, make sure to hit the like button. It really supports the channel and helps us keep producing these in-depth guides. Also, if you've got any questions, feel free to drop them in the comments. We always do our best to respond to everyone. So, what are the main factors to watch for when trading order blocks? We have grouped all the factors into 4 important categories: market structure, volatility and spread, overall trend, and confirmation from lower time frames. Let's start with the market structure. Take a look at this example. We've identified a valid order block that presents a potential long setup. But if we examine the price action to the left, we can see a clear gap between candles just beneath this order block, along with another valid order block zone lower down. This creates a likely scenario. Price may move down to fill that gap, sweep the liquidity below the first zone, and then bounce off the second order block to continue the upward move. So when we see this kind of pattern, a gap plus another strong order block sitting just below the first, we lower the score or priority of the first zone by 1 point. And just a reminder, if price breaks below the first order block, it doesn't always mean a trend reversal. Quite often, it's just a liquidity grab, a quick move to collect orders before continuing in the intended direction. Now, let's look at a different scenario. And this one works in favor of the order block. In this second pattern, we have another valid order block, but this time, when we look to the left, we can clearly see that price previously swept the liquidity beneath a cluster of equal lows. So when we see that the order block forms right after a sweep of equal highs or lows, we add +1 point to its quality score. It's more likely to hold. The third pattern builds on the same idea. Imagine price is approaching an order block, and just before it gets there, it starts forming a temporary support level. Retail traders often place their stop losses just under these short-term supports, creating a perfect target for smart money to hunt. So what usually happens? Price drops just enough to grab that liquidity below the equal lows and then pushes upward once it hits the actual order block zone. Now, let me show you a real example on the chart. This is the Euro USD on the 1-hour time frame. We've identified a valid order block that caused an inefficient move and a break of structure. But if we look further left, we can also spot a clear support level that held multiple times. That tells us there's likely a lot of liquidity sitting just below it. On top of that, we notice a gap directly under the zone and another valid order block a little lower. This gives us a high probability setup. Price is likely to break below that liquidity, fill the gap, and then reverse from the lower order block, continuing its upward move. Let's walk through another setup. In this case, you could technically consider either of these candles as valid order blocks. We've got a clear gap, a break of structure, plus a mitigated order block. When price breaks below this higher low, some traders might immediately assume it's a change of character, but take a moment to scan to the left. You'll spot another clean gap and a valid unmitigated order block sitting right beneath that level. That gives us a strong clue. What looks like a trend reversal might actually just be a liquidity grab, and the market may still be in bullish territory. Now let's flip it and take a look at a bearish example. Here on the Euro USD 1-hour chart, the market is clearly trending downward. We can identify an order block that caused an inefficient move and a clear break of structure. That already makes it a solid setup. But here's what makes it even more interesting. The initial move that started this entire leg was a liquidity sweep. That tells us smart money likely stepped in at the start, so we give this setup plus 1 point as a high probability trading opportunity. Now, let's clarify something important. Not every losing trade means you made a mistake. Even the best setups won't win 100% of the time, because the market isn't something we can control. Losses are simply part of the game. Now, let's talk about the second key factor to pay attention to when trading order blocks: market volatility and spread. Looking back at our backtesting data, one pattern was clear. The majority of winning trades happened on high volatility days. In contrast, trades placed on the first or last day of the week, when liquidity is low, were far less reliable. That's why midweek trading, when volume picks up, tends to offer better results. Also, for pairs like EUR-USD, timing matters. You'll want to trade during high activity sessions like the London Open or New York session. If you're trading during quiet hours, the market just won't give you the kind of moves you need to make this strategy work. Another crucial detail when trading order blocks, and one that's often overlooked, is how you handle the spread. Many times, price will react to an order block within a single pip, but if you're trading a pair with a wide spread, it can completely throw off your execution. You might miss out on what would have been a perfect entry, or even worse, your stop loss could get hit, even though the real price never touched it. So managing spread is not just a technical detail. It can actually make or break some of your trades. Now, let's move on to the third key factor: market trend direction and the freshness of the order block. Here's what we've observed. Order blocks tend to work much better in trending conditions. In choppy or sideways markets, the success rate drops significantly. That's why it's usually smarter to trade in line with the prevailing trend. When the market is clearly moving up or down, order blocks that align with that direction have a higher probability of holding. Also, how fresh the order block really matters. Recently formed zones tend to be more reliable because market sentiment hasn't shifted much yet. If you're waiting around too long for price to come back and touch an old order block, chances are the dynamic between supply and demand has already changed, making the setup weaker or even irrelevant. Take this example on Euro-USD during a strong uptrend. You'll notice the market keeps forming fresh order blocks, tapping into them, and then continuing the bullish momentum. This kind of price action confirms that trading with the trend and focusing on fresh zones significantly increases your chances of success. Now, let's look at a different type of scenario. In this example, we've identified a valid order block zone, but before price even reaches that level, we can see the market forming multiple demand zones and breaking right through them on the way down. Some traders might interpret this as a series of liquidity grabs and place buy orders at the order block. But in reality, what's happening here is that supply is clearly in control. So blindly entering on this order block without confirmation is a risky move that could lead to a loss. If you want more trading lessons, market insights, and live analysis, feel free to join my Telegram channel. It's completely free, and I'll leave the link in the description below. And that brings us to our fourth key factor when trading order blocks: confirmation from lower timeframes. This step can save you from tons of unnecessary losses, especially when price simply disrespects your higher timeframe zone. Having a reliable confirmation method gives you a clear reason to enter and helps you trade with a lot more confidence. The beauty of this strategy is that it's not limited to any specific time frame. Here's how we approach it. Once we identify an order block on the higher time frame, we zoom in, usually 2 time frames lower, and wait for confirmation before pulling the trigger on a trade. This multi-time frame confirmation approach makes sure we're not just reacting to price, but actually aligning our trades with momentum and structure. When we're trading, we typically use the 4-hour, 1-hour, and 15-minute charts as our higher time frames. Then for our entries, we zoom in to 15-minute, 5-minute, and 1-minute charts respectively. You can apply a variety of price action setups to confirm your order blocks, and here are some of the most common patterns we rely on. The first step is waiting for the market to mitigate the order block on the higher time frame, and then watching for price action to give us a clear signal for the next move. One of the key things we look for is a change of character. A change of character marks the end of a short-term downtrend and suggests that the market is ready to shift direction, in this case, likely to the upside. Once we spot this shift, That's when we prepare to execute the trade. Now, in terms of patterns, there are two main setups we focus on. The first pattern occurs when the change of character creates an inefficiency that forms a valid order block. In this case, we place our entry just a couple of pips above the order block and set our stop loss a few pips below the lowest point of the zone. To capture larger risk to reward ratios, we use a simple profit-taking technique that allows us to maximize potential profits without feeling too much tension in the trade. If our analysis proves correct and price starts moving in our favor, we'll adjust our stop loss to trail under the market structure. Every time the market makes a new higher low, we'll move our stop loss to lock in profits and allow the trade to run until it reaches a higher time frame supply zone, at which point we'll exit the trade. Now, the second pattern we trade happens when there's a change of character, but we don't see any inefficiency or gaps between the candles. In this case, we use retracement levels to find our entry. We place the retracement tool from the start of the change of character move to the end, and then look to enter a buy position between the 0.61 and 0.78 Fibonacci retracement levels. We set the stop loss a few pips below the swing low, and our target is typically the next level of structure ahead of price. It's important to note that these setups are not restricted to any specific time frame or currency pair. However, it's essential to backtest and identify which pairs perform best with these strategies.
After breaking down my first trading strategy, now I will share with you my second order block trading plan and strategy. Let's break down how a high-quality order block setup actually looks on a live chart. Looking at the market here, the first thing to note is that price is trending upward. That brings us to step 1, determine the directional bias. You can see price forms a low, then a high, then pulls back respecting a previous bullish order block, which we already discussed. After that pullback, we get a strong impulsive move to the upside, which leads to a clear break of structure. That confirms we're in alignment with the trend, which is a pro-trend scenario. This break of structure stems directly from a reaction off the bullish order block, which reinforces its significance. Next, look at what happens before price moves higher. There's a liquidity grab. You'll notice price dips into a zone with relative equal lows, essentially sweeping that liquidity and then immediately shoots upward. That final push down before the aggressive rally represents a textbook liquidity run. So at this point, we've checked all three criteria. Trend is bullish. Price has swept liquidity. There's a break of structure within the same price leg. That tells us our order block is valid and falls within the active range we're trading in. Now all that's left is to mark out the order block zone on your chart and watch how price behaves as it returns to that level. So what happens next? Price comes back to the zone, reacts with bullish momentum, dips slightly deeper into the block, and then pushes aggressively higher, breaking structure again and continuing with the prevailing trend. Now we're going to take it further. We're now inside the London session, and it's time to apply the strategy. Step 1. Define the trend direction. Looking at the chart, it's clear that price was previously in a strong bearish trend, creating a series of lower lows and lower highs, which led to a break of structure to the downside. However, things shift when price forms a higher high, breaking the previous high. This signals a change of character, meaning the bearish trend has ended and a bullish trend has now taken over. From this point forward, we're no longer interested in short setups or bearish order blocks. The trend has flipped, and so our focus is now entirely on long opportunities, staying aligned with current market momentum. Step 2. Identify a valid bullish order block. Now we need to locate a solid order block that fits within our bias. To do this, we start by looking at the Asia session, marked by the blue box here, which spans from 8 p.m. to midnight EST. This range is important because the highs and lows of the Asia session are typically rich in liquidity. Since we're looking to go long, our ideal scenario is for price to sweep below the Asia session low before bouncing. Looking closer, you'll spot a clear order block below that Asia low, specifically a final bearish candle before a sharp bullish move. You'll also notice that this sell candle runs liquidity. It takes out the low of the previous candle before price explodes upward. That makes this a textbook bullish order block. It's below the Asian session low, it follows a liquidity sweep, and we've already seen a break of structure confirming trend direction. So what's the plan? We want to see price pull back, sweep the Asia session low, and tap into this order block zone, so I'll be looking for a refined entry setup within the zone to maximize my trade. What I'm aiming to do now is refine my entry, and for that, I need to drop into the 1-minute time frame once price taps into our higher time frame order block. So first things first, I wait for price to enter the zone. And here we go, the objective is met. Price has swept the Asia session low and also taken out a set of equal lows, an ideal liquidity grab. That's our signal. We've now entered a prime demand area, and all the higher time frame conditions are in place. Pro trend, clear liquidity run, strong order block zone. Now it's time to fine-tune the entry. The next step is to assess the immediate trend within this smaller time frame. We're clearly in a short-term downtrend. Price has been making lower lows and lower highs, and most recently, it just swept a key low, the same low that had previously supported a small bullish bounce. This liquidity run is crucial. What we need now is for price to break above a previous high, signaling a shift in structure. That confirms that the 1-minute chart is now aligning with the bullish direction of the higher time frame, 30-minute in this case. And there it is, price breaks above that minor high, giving us both a market structure shift and a clear displacement. This confirms that sellers have lost control and buyers are stepping in. Now we're looking for our entry zone. We want to identify a bullish order block that triggered this break in structure. Specifically, we need to find a sell to buy move within this 1-minute move that caused the market structure break. That last bearish candle before the rally is our entry-level demand zone, a refined bullish order block on the 1-minute chart. Now that we've identified the valid bullish order block, the one responsible for breaking structure, we can prepare for our entry. Looking closely, this block contains a fair value gap, since the wicks of the first and third candles don't overlap. That confirms our imbalance, and this zone becomes our entry area. The stop loss? We're placing it just below this recent low. Yes, it's a tight stop, and that's intentional. We're aiming for precision here. As for our target, since we're trading in line with a confirmed bullish trend, we'll look to aim for the next logical high in structure, ideally giving us at least a 1 to 5 risk to reward setup. That's our minimum goal. Now, once price enters the zone, we place our trade and monitor the market. As price starts moving, we notice a shift. It begins forming a range. And here's a crucial lesson. Whenever the market consolidates like this, it's typically accumulating liquidity on both sides, buy side and sell side. What usually happens next is a fake breakout. Price might first sweep one side, in this case, the equal highs above, trapping breakout traders, only to reverse and sweep the other side. This is a liquidity trap schematic, a very common play by smart money. In our case, price sweeps the buy-side liquidity by running those equal highs. Then, it starts forming equal lows below, stacking more liquidity. Our trade plan remains valid as long as price hasn't already hit take profit before tagging us in. Finally, price responds perfectly, launching aggressively out of the zone and hitting full take profit, all based on structure, liquidity, and timing, not guessing.
That's it for this video. I hope it gave you a clear understanding of how to properly identify and confirm order blocks using bias, context, and retracement logic. Remember, it's not just about spotting levels, it's about reading the intention behind price. Thank you for watching. If you found this valuable, make sure to like, comment, and subscribe for more in-depth trading breakdowns. See you in the next video.